to 6,000 crores by FY27. Thank you so much, Narendra.
Sir, any target on how many new anchors do we plan to add?
So by FY27, we should be about 75 odd anchors.
From the current 35, right?
From the current 37 anchors.
Yeah.
But the focus is going to be on the large corporates because we're going to be focusing on fast-moving and the companies which hold leadership position in the industry, one or two only.
Okay. Great. Understood.
Thank you.
Sir, and regarding the current book is small in size, but as we grow, do we see this kind of asset quality being maintained, or do we see somewhat here and there some asset quality issues coming back?
Yes, when the asset quality is key, as we mentioned, we already were at a book of 2,000 crores at peak levels. And we've done disbursements of 30,000 crores, which is a large number, and 700 borrowers. So asset quality, we will continue to maintain at similar levels only. So there is one very key aspect to be noted here in supply chain financing is that all our borrowers are onboarded through a top-down approach. We do not have a single borrower which is onboarded without a memorandum of understanding with the parent. So firstly, we will go to a Tata Motors Vedanta, sign up an MOU, take their recommendation for that particular dealer, and then only onboard any of our borrower. So for all of our borrowers, we will have a recommendation letter from the anchor, B, an agreement with the anchor that in case this dealer distributor delays or defaults, then they will not make any supplies to this borrower in future. So understand that it is the livelihood of that dealer distributor which is dependent on that anchor. And if he delays defaults with us, he will not get goods any longer. That means his livelihood will come to a halt. That is the key that we hold, and that is present for each and every borrower of ours.
In addition to that, we, as already mentioned, we are also in process of developing an AI-based monitoring tool, which will help us in assessing the borrowers for their continued credit worthiness and financial performance. In this industry, a very key aspect for the borrowers or the distributors or dealers is diversion of funds. We monitor that very keenly in the sense that whenever we do our assessment, wherever there is excess funding or sufficient funding with the borrowers, we do not shy away from rejecting and do not going ahead with onboarding that particular customer, because that being traders, the diversion of funds in this industry is very common.
Yeah.
So our group is very clear that we want to be in business of lending, not collection. The asset quality remains number one priority before we disburse even $1 of loan. And in the last 24 months, the performance, what we have seen of 30,000 crore worth of disbursements without any NPA. So this gives us more confidence of our practices and protocols which we have set. And same we shall follow when we triple our loan book.
So if I have understood right, you mean to say that if the borrower defaults, the anchor stops doing business with that guy, right?
Yes.
Great.
That is a stop supply agreement that is there with us for each and every borrower.
Thank you.
Plus the relationship should be at least 5 years old between the anchor and the distributor, and more than 50% of his business should be coming from that anchor.
Thank you, Mr. Narendra. Please fall back in the queue for more questions. Next question comes from the line of Harshit with Premji Invest. Please go ahead.
Hello. Hi, sir. Am I audible?
Yes, Harshit, you are audible.
I think one question continuing from the previous one, that these kind of arrangements with the prime lenders, I think a lot of our asset quality comfort is driven by the large corporate with whom are tied up. Now, many of them have their own financing arms also. And what stops this becoming a very competitive model so that any other player does not come in with it? And second is that what would be the incentive for these large players for having such a terms and condition in the contract? And the second point is that, as you said, that the relation should be 5-year-old. Now that stops many of the newer relationships which they are having from having access to financing from us itself. So if you can throw some more light on what is the competitive mode we have as a lender with respect to these arrangements. And second, if I may just ask, is there any security per se on contractual terms in these contracts? Security in the sense security of the borrower, or these would be more of unsecured loan nature? I mean, just technically, will there be a security attached to it or not?
Thanks, Harshit. So 3 points are, do these large corporates have their own financing arm? Answer is yes. A lot of them do and a lot of them don't. So there is space available for other financial institutions, and it is competitive. As we explained the landscape, banks operate at 9 to 11%, but on lower risk profiles. We operate at 11 to 13%, which is right next to them, and 13 upwards is all fintechs and the smaller NBFCs. So do we have our space? The requirement of, as I said, Tata Motors itself runs a supply chain financing program of about 7 to 8,000 crores, wherein SBI has also done about 7 to 800 crores only, or maybe 1,000 crores. There is a limitation of risk appetite with every financial institution, and there is space available for us. And that is the reason we've been able to penetrate and get into agreement with all these guys. Yes, newer relationships, there is a hindrance because we at least look at a track record of 5 years, in some cases at least 3 years. Track record happens to be very key whenever we're doing our assessment, and 3 years is minimum that we keep. Third is security. Yes, majority of our exposure, about 85% plus of our exposure is security backed. Do we take collaterals? Answer in some cases, yes, we take collaterals. B, it is mandatory that we will keep charge on the assets which are funded by us and receivables generated thereon. 3, we will have personal guarantees of all promoters, and in case it's a proprietorship, we will take personal guarantees of wife, kids involved in the business. D, we will have security checks available with us for the entire facility we've given. So Section 138 becomes key there, but personal guarantees are there. So overall, we've seen the MSMEs, if the intention is okay, they do not want to jeopardize their livelihood by defaulting with us. And the churning is about 30-35 days. So the amount of limit that we have equivalent to the kind of turnover that they're doing is quite small. So that is the reason, that is one of the reasons that we found that they do not want to default. They're cognizant and they operate supply chain financing sincerely.
In addition to that, I would like to point out that this industry, supply chain industry, is divided into mainly 3 categories. One is, first comes the banks. The banks are the banks lend in the range of around 9 to 10.5%. Whereas when a particular larger bank approaches a client, they usually offer multiple range of products. A bank such as Kotak, etc., with a large loan book of 4.5 lakh crore would not have a pure focus on supply chain finance. So we are able to compete in that sense with some of the banks wherever there is multiple banking in terms of in terms of channel finance arrangement. Secondly, next comes the larger NBFCs such as Tata Capital, Aditya Birla Finance, with whom we are able to compete in the sense that we have a pure play focus on supply chain finance with a lot of innovation on the kind of platform that we have built and the flexibility that we are able to offer. Thirdly, then comes the commercial front. We are not too far and are able to compete on the commercial front as as well with the larger NBFCs. But then later on comes the other bracket, which offer the NBFCs, which offer in the range of 13, 14 and above, with whom on the commercial front we are able to compete.
Okay. Sir, if I can just ask one more question on the economics part of it. So one, you said that we lend at say 12-13%. Right now we don't have any leverage on balance sheets, so probably but when you say 4% ROA, I guess you mentioned that we would be more like a 2,500 crore balance sheet or net worth and 6,000 crore balance sheet at that point of time. If you can explain that, how do you get that 18% ROE, 4% ROA when you say the cost part of it, if there are any payouts or basically any linkage to the large corporate through whom we are lending, or basically who become the nodal point. And at that point of time, see, so even for a 4% ROA, I mean, we would be more like a 2 times leverage, 2.5 times leverage. So how does that 18% ROE comes up? So those two questions, one that ROE and the other part is the 4% ROE. If you can just break down the key cost which you assume.
4% ROA was calculated on the assumption of 1,500 crore net worth and 3 times leverage on that net worth, which will give us 4,500 crore of loans from the banks. So 4,500 crore of loans and 1,500 crore of net worth. So that's how 6,000 crore will come. On 1,500 crore, we shall be earning 13% direct, right? On 4,500 crore, we shall be earning around 5% spreads. And if you sum these up, so the ROA will come around 4% plus with ROE of 18%.
And sir, any cost? I mean, more in terms of, so we operate in a very lean structure, which you, as you said, that we don't have any collection team because we will not need that collection. But what would be the major cost in this model? Apart from finance cost, is there a distribution fee which keeps that large corporate incentivized? So will there be any major cost structure if I look at it below the NIMs line item?
So no, there are no such costs. We do not have any distribution channel, nor there are any incentives or any payouts given to the anchor. It is all direct sourcing, and I think after this, employee and tech cost will be the only major costs after finance cost.
So usually our other apart from finance cost, our other costs are controlled in a very, very well manner because of the business model in which we operate. The business team is divided in a manner that there is anchor team or the large corporate team which approaches the anchor and signs up MOU with them. That team is composed of couple of individuals, and then there is another set of business team which approaches the prospective borrowers or the qualified leads that we get from those anchors. That part of the business team is responsible mainly for the execution. So that is why our costs are controlled in a well-mannered manner.
Thank you. Mr. Harshit, please rejoin the queue for more questions. A reminder to all the participants, please restrict yourself to 2 questions. The next question comes from the line of Aditya Late with Akshita Capital. Please go ahead.
Hello. Hello, am I audible?
Yes, Aditya.
Hi, Saurabh, first of all, congratulations on strengthening the board. So it's heartening to note that we've got 2 additional independent directors, Mr. Shekhar Masoor and Mr. Jagmohan. So good to see that we have now 5 independent directors on the board. So my I have 2 questions pertaining to the book. So the first question is, we had a book of around 1,600 crores in March end, which has come down to 800 crores in September. So if you could just elaborate on that. And the second question pertains to the provision of 5.6 crores that we have done in this quarter and half year, September. So if you could just explain, give us more details on that. So is it a vendor discounting or a dealer discounting? Is it secured, unsecured? And the length of relationship with the customer that we have. So those are my questions.
So coming to the first question, on the trimming down of book, that was because of we were in process of getting Type B license from RBI. During that process, we had to trim it down. So now the license is in place, and it will ramp up to 2,500 crores by March 25. Saurabh, can you take second question?
Yeah. So we've done additional provision. There is absolutely no dent on the book right now. So we've taken additional provision because we had run down the book. So that is the only reason of keeping that provision. And majority of that provision is against standard assets. All this provision is against standard assets only, and expecting a loan book of reaching 2,500 crores in this financial year. So we've taken a higher provision in this quarter. Thank you.
Okay. So as I understood from the disclosure, it was for one particular customer. So
No.
That okay.
So there is no such particular customer.
Okay, fine. That's it. Thank you.
Thank you. Next question comes from the line of Chinmay Nema with Prescient Capital. Please go ahead.
Hi, sir. Good morning. Two questions from my side. Firstly, could you give some sense around what kind of retailers or dealers you work with in terms of their revenue turnover or inventory churn? Are there some kind of thresholds that you look at? And secondly, if you could give more color on the operations from underwriting and collection standpoint, what kind of documents do you collect? Do you have a feet on street team? Do you visit these dealers? Basically, what kind of credit assessment happens?
So Chinmay, what kind of documents we take? We have access to the ITR and GST portals. We take complete access, and the credit risk assessment note is prepared from the ITR and GST portals. Do we meet these customers? Each and every dealer distributor that is onboarded is met by the customer, met by our team in person before any penny goes out. There is a full-fledged report that is submitted, and basis that report, field report, only any disbursement happens. As we initially also mentioned, that there is a comfort that is there from the anchor. The recommendation letter is already in place from the anchor.
And sir, about collections, do you have an outsourced collections team or is it in-house?
We have our collections team is in-house only. We have business team who's responsible for collections as well, and specific collections team as well, which is doing collections from borrower to borrower. Otherwise, our collections is all timely. Very, very small, negligible overdues happen. So that is why as we said, that we are into business of financing and not business of collections. So everything right now is extremely under control by the existing team itself.
Got it. So would it be possible for you to share the team strength of the underwriting and the collections team? How many people are there?
So in the underwriting team, there are about 12 people. In collections, there are 4 people, and business team is about 22 people. Total strength of the company is about 61 people as on date. And it is expanding further. We are also opening up new locations and adding business people also as we are ramping up our business.
Got it, sir. Thank you.
Thank you so much.
Thank you. Next question comes from the line of Rakesh Khosla with Tanishq Investment. Please go ahead.
Hi, good morning. Thank you for the chance. So I've seen your earnings presentation. It tells you the way the loan book is going till 2027. But if you go 2 pages before that, it says we aim to maintain a debt to equity ratio at a decent level. You have answered some part of it, but if you can just directly answer, what is it? What is the debt to equity ratio? What is your perspective on it? How you want to take it forward? Thank you. That's my only question.
So going forward, we aim to maintain our debt to equity ratio at 3:1 levels.
Okay. So as of now, it is not. So when when we get that?
As of now, our entire book is funded by the equity, whereas we will be leveraging the book going forward. We had a rating of AA previously. However, the same we had to withdraw the same. However, we have initiated the same again, and we'll be getting the rating soon.
So Rakesh, 6,000 crores of book, 1,500 crores of equity, and 4,500 crores of debt. So that is the plan for next 2.5 years.
Yeah. You have given, as I said, you have given some flavor for it. Okay. Thanks.
Yeah.
Lovely.
Thank you.
Best of luck.
Thank you.
Thanks.
Thank you. Next question comes from the line of Yash Modi with Ashika Group. Please go ahead.
Yeah, good morning, sir. Thank you for taking my question. My first question was with respect to this Type 2 license. So in the beginning of the call, Anubhav mentioned that we are shifting from a dealer-based model to a retailer-based model. Is it because we are going to launch our app, and where are we in terms of launching our app that we'll be able to do this? That was my first question.
So I guess we shall start this in April 2025. Right now that we have the license and we got the company further capitalized, plus we have the limit sanctions from the banks. So that we will start in April 2025. But we have mapped the universe, which is around 6,000 crore of loans which the distributors have disbursed to their retailers. And assuming that we pick the cream out of it, which could be like 20% of that, so 1,000 crore is what we can build the book in the next 2 to 3 years.
Sure. And secondly, because we had an initial credit rating of AA, I think AA or AA plus, so we don't expect any, the rating should be similar, right? Because earlier we had not taken any loan, but the rating...
It shall come back. It shall come back. It was just withdrawn during the period of getting the license. So it shall come back, yes.
Sure. Those are my two questions. Thank you so much.
Thanks. Moderator, we still have long queue. Can we request the participants to ask one question? And then we will have a follow-up. We are all reachable after this call as well. So let's speed up, please. Thank you.
Sure. A reminder to all the participants, please restrict yourself to one question. Next question comes from the line of Rohan Mehta from Fincom Family Office. Please go ahead.
Hello, sir. Thank you so much for taking my question. Am I audible?
Yes, please.
Go ahead, please.
Yeah. So, with a target of 2,500 crores in loan book by FY25, what kind of a quarterly disbursal run rate you are looking at, considering you're also moving now into long duration products? So what do you think that number can be by Q3 and Q4?
So right now we're doing about 4,000 crores per quarter. And if we have to add another 2,500, we have to add another 1,500 crores, it will be close to about 5,000 odd crores per quarter. That is the disbursement run rate.
All right. Got it. And if my permission, can I ask one more question?
Rohan, sorry, there are other investors in the queue.
Sure. No worries. Thank you so much.
Thank you. Next question comes from the line of Moksha Shah with Agility Advisors. Please go ahead.
Hello, sir. Am I audible?
Go ahead.
Yeah. So my question is, how is the loan book distributed between the top 5 anchor clients and the rest? Could you share a percentage split or a concentration risk in it?
Top 5, so distribution, if you talk about top 5 anchors, it would be about 50 to 60%, and balances in the other anchors. But there is a regional aspect also involved, and the distributors do different products also of the different anchors. So it is quite well distributed.
Okay.
And if you remove Apollo Group out of it, then the distribution will...
then it will be equally distributed. Yeah.
If I'm not wrong, you just mentioned that the Apollo Group is around 25 to 30% is the share of the group business, right?
Yes.
Okay. Thank you so much, sir.
Thank you.
Thank you. Next question comes from the line of Anukul Agarwal with InvEd. Please go ahead.
My questions are being answered here.
Thank you, Anukul.
Thank you. Next question comes from the line of Vineet Agarwal with Aditya Birla Money. Please go ahead.
Thank you for the opportunity. So just one question. Like quarter two numbers was a bit muted. So is it because of margin pressure or a seasonal nature kind of thing, or how should we read this?
No, this was only because of the trimming of the loan book as we were in process of getting the Type 2 license.
Okay. Thank you.
Thank you.
So just to add that Q3, the run rate will go back to like previous quarters run rate. All right. Next question, please.
Thank you. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to Abhijit.
You can take one question, Mr. Moderator. One last question.
All right. Sure. The next question comes from the line of Meet-to-be Shah, an individual investor. Please go ahead.
Hello, am I audible?
Yes, please.
Okay. First of all, thanks for giving me the opportunity. So I have only one question. We have seen Sanjay Gupta ji as massive scaler and great capital allocator. As we can see, this company is professionally managed. So can we expect similar growth trajectory as we have seen in the past from this group?
Yep, that's the vision. That's why we capitalized the company well enough to reach 6,000 crore scale, right, by FY27. The same values are in this company, like we were discussing on the lean cost structure, etc. And with the support of the investors, we shall be able to achieve similar heights which our other group companies have done.
Thank you, and best wishes for your future.
Thank you so much.
Thank you. It's time. Shall we go ahead and close it?
Yes. Thanks so much, everyone. If there are any unanswered questions, we request each one of you to reach out to our team. The contact details are in the presentation, and we shall be happy to address. Thanks so much.
Thank you. We'll also hand over to Abhijit Tibrewal for closing comments.
Yeah, thanks, Ranju. I mean, on behalf of the team at Motilal Oswal, we would like to thank the management at SG Finserve for giving us this opportunity to host their first earnings call. We look forward to remain associated with it. Thank you so much, investors, for diving into this call.
Thank you. On behalf of SG Finserve Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.